People often claim they're struggling financially, with money stress reaching levels unseen in recent years. They say everything seems more expensive, uncertain, and harder to handle than before. Yet, despite these challenges, restaurants are packed, airports are buzzing with travelers, and every holiday shopping season seems to break spending records. At first glance, this seems completely contradictory. Historically, the link between financial strain and consumer behavior has been predictable. When individuals faced financial pressure, they reduced spending, they postponed purchases, cut back on non-essential items, and prioritized survival over comfort. But this old pattern has slowly unraveled. Today, many households feel financially worse off than in years past. Yet they continue to spend, though not always in reckless or impulsive ways. Rather, their spending persists, often hidden in ways that aren't immediately apparent but will eventually become clear over time. This isn't about blaming people for their financial decisions or claiming the economy is strong simply because spending hasn't dropped. It's about understanding why spending no longer accurately reflects financial stability. What might appear to be resilience on the surface may, in fact, signal something quite different beneath the surface. If you step back and examine the bigger picture, you'll realize this isn't a story about consumer confidence. It's a tale about mounting pressure, with emotional spending becoming normalized. It's a story about how easily accessible debt has reshaped the way individuals cope with uncertainty. In the past, consumer spending was often a direct reflection of financial health. Today, however, it reveals something else entirely. Recognizing this shift is crucial, not just for understanding the economy, but for anticipating what lies ahead. One of the most puzzling aspects of the current economy is the growing disconnect between what people say about their finances and how they actually behave. On one hand, surveys repeatedly show high levels of anxiety. People report feeling financially stretched, worried about rising costs, job security, and uncertain about their financial future. On the other hand, consumer spending seems to tell a completely different story. People are still taking vacations, shopping, and engaging with the retail sector, acting like active and engaged consumers. Economists have a term for this growing divide between how individuals describe their financial situation and how they behave in response to it. Before the pandemic, this gap was smaller. Typically, when confidence dropped, so did spending. When optimism returned, so did spending. But since the pandemic, this connection has weakened and, in some cases, broken entirely. A key reason for this is that the world people are responding to feels fundamentally different. Uncertainty has become a permanent fixture. It's no longer tied to one specific event or cycle, but rather seems continuous, layered, and unpredictable. When uncertainty becomes a constant, people change their behavior. Instead of seeing spending as something to delay until conditions improve, many now view it as something to preserve while they still can. This is not driven by a sense of security, but by the belief that waiting for better times no longer feels rewarding. In this environment, traditional surveys lose some of their predictive power. People may honestly report feeling pessimistic about their finances but still behave in ways that appear optimistic on paper. This is where the misunderstanding starts to take shape. When analysts, policymakers, or media outlets point to steady consumer spending as evidence that people are managing well, they often overlook a key psychological shift taking place beneath the surface. Spending isn't necessarily a clear indication of financial strength anymore. Instead, it's increasingly a sign of people adjusting to their circumstances. Consumers aren't spending because they believe everything will eventually get better. They're spending because life keeps moving forward, regardless of how uncertain or uneasy they feel about what's ahead. This shift in behavior changes how we should interpret the data and what we need to pay attention to in the future. Each time economic worries resurface, there's usually one statistic that is used to argue against those concerns: holiday spending. Retail sales surge, and headlines frame this as proof of consumer resilience and a stable economy. However, context is key here, because higher spending doesn't always translate to people buying more goods. In today's economy, that difference is crucial. Over the last few years, the way people spend has changed. With rising prices across the board, households are spending more, but they often end up with fewer products in return. The cost of a shopping cart might be higher, but it doesn't necessarily mean the contents are worth more. It simply means that essentials and everyday items have become more expensive. This is why retail sales figures can be misleading. They reflect total dollars spent, not actual purchasing power. They show how much money is flowing, but not how much comfort that spending is providing. There's also been a structural shift in how people pay for things. Online shopping has reduced the friction of buying. With features like one-click checkout, saved payment methods, and installment plans, spending feels less burdensome in the moment. The psychological pause that used to make consumers reassess their purchases has weakened significantly. As a result, holiday shopping has shifted away from being an indulgence to being more about emotional priorities. For many families, these purchases are no longer seen as optional. They are viewed as necessities to uphold traditions, maintain a sense of normalcy, and bring joy in a year filled with uncertainty. This is why holiday spending can still rise even when consumer confidence is on the decline. It's also why stores may still be crowded even when households are financially stretched. What appears to be consumer strength is often just a rearrangement of priorities. People may quietly scale back in other areas, savings, long-term goals, and future flexibility, while continuing to spend in visible ways. That's the danger of using holiday spending as a gauge of economic health. It shows that money is still circulating, but it doesn't explain why or what's being sacrificed beneath the surface. When spending is driven by pressure rather than confidence, the message it sends is much less reassuring than it seems. To truly understand why spending has stayed so resilient in tough times, you need to look beyond traditional economics and delve into psychology. For more and more households, spending has become an emotional response, not just a financial decision. Emotional spending isn't about recklessness or poor impulse control. It's a reaction to the strain of constant stress, especially when uncertainty persists for months on end. When the future feels unstable, the brain seeks relief, not in the form of long-term planning, but in the short-term comfort of stability. Purchasing items offers temporary relief by providing a sense of control in an environment where many feel increasingly helpless. It creates fleeting moments of normalcy when everything else feels uncertain or fragile. This is particularly true for families, where parents rarely make spending decisions in isolation. Instead, they make choices with a sense of responsibility, especially when it involves their children. Skimping on personal wants is one thing, but cutting back on gifts for birthdays, holidays, or shared family experiences feels fundamentally different. As a result, these trade-offs often happen quietly. Vacations get delayed, savings are cut back, and long-term plans are put on hold. However, visible spending remains relatively unaffected because it helps preserve something highly valued, the sense that life hasn't yet become entirely restricted. Emotional spending, then, has become a normalized response. It's not driven by hope for the future, it's motivated by the need to protect meaning in the present, especially when the future feels uncertain and harder to rely on. The issue, however, is that emotional spending doesn't erase the financial impact. It simply postpones it. Money spent today to feel better doesn't vanish. It eventually shows up as tighter budgets, larger debt balances, and less flexibility down the line. And because these costs are abstract and delayed, they are easier to ignore in the moment. Over time, this results in a delicate balance. Spending continues, not because households are thriving, but because cutting back feels more painful than facing the future consequences. This is when spending shifts from being a sign of confidence to a coping strategy. What might appear to be sustainability on the surface is actually building up hidden costs beneath. The emotional motivations behind spending are clear, but debt explains how it all works. Without easy access to credit, much of today's spending would be unattainable. Over time, debt has gone from being a backup option to an essential part of daily life. Credit cards, installment plans, and deferred payment programs have blurred the distinction between having money and simply having access to it. For many families, the line between the two has almost disappeared. What sets this cycle apart from previous ones is how commonplace this reliance on debt has become. Debt is no longer reserved for emergencies or big-ticket items. It is now routinely used to manage everyday expenses like groceries, utilities, travel, and even seasonal costs that were once covered in cash. This shift alters the way people experience spending. When the immediate cost is small, spread out over time, or hidden behind deferred payments. The financial impact feels distant. It becomes something to handle later. And, later, is where the risk builds. As debt balances increase, financial flexibility decreases. As minimum payments rise, margins for error shrink. With growing obligations, even minor shocks can have a significant impact. This is how a consumer debt crisis slowly takes root, not through a sudden financial collapse, but through a quiet normalization of debt-fueled spending. Each individual purchase feels manageable, but collectively, they create a system that depends on stability to function. The problem is that stability is exactly what many households lack. Debt-driven consumption can make the economy seem healthier than it truly is. It keeps money circulating, boosts sales figures, and postpones visible financial strain. However, this hidden dependence on credit only makes the underlying risks more perilous. However, this shifting of vulnerability doesn't just disappear into the future. It often grows harder to manage over time and becomes more easily ignored until circumstances change. When those changes arrive, whether it's through job losses, reduced working hours, or rising costs, the very debt that once made spending possible becomes a significant constraint. At that point, households don't merely need to adjust their way of life, they need to completely undo it. This is why debt plays such a critical role in this discussion. It's not just facilitating spending. It's redefining how people cope with uncertainty and how vulnerable they are when that uncertainty eventually becomes a reality. One of the most common misconceptions in today's economy centers around inflation. Media outlets often focus on declining inflation rates or reports that suggest inflation is cooling off. On the surface, that sounds like good news. However, for many households, the reality feels quite different. Slower inflation doesn't mean prices are going down, it just means they're rising more gradually than before. The harm has already been done, and prices are locked into a higher baseline. Everyday expenses, food, insurance, housing, and services, have all reset upwards, and very few of these have decreased over time. For households whose incomes haven't kept pace with these higher costs, a permanent gap has formed between what things actually cost and what feels affordable. This is where consumer spending behavior can easily be misunderstood. People aren't making choices based on inflation reports, they're responding to the prices they see in front of them. They remember what things used to cost, and they feel the difference every time they pay a bill, even when wages have risen. However, these wage increases often feel absorbed into the rising costs before they even provide any real breathing room. So, when people continue to spend, it's not because inflation feels under control. It's because cutting back doesn't bring back the past, it just makes the present feel even tighter. This is why inflation continues to have a lasting psychological impact. Even after the peak has passed, it erodes trust in financial stability, shifts expectations, and strengthens the belief that waiting for things to improve isn't always an option. In this environment, spending becomes less about timing the economy and more about managing the current reality. And this leads us to the next pressure point that ties everything together, influencing how long this behavior can continue. On the surface, the job market still appears stable. Unemployment hasn't surged, jobs are still being created, and there isn't a single headline declaring a full-blown crisis. But beneath this apparent stability, the structure of the job market has changed in ways that people are already feeling, even if these changes haven't yet fully shown up in the data. Much of the recent job growth has been concentrated in specific sectors like healthcare, social assistance, and other areas tied to essential services. Meanwhile, many higher-paying, more flexible roles in industries like manufacturing, logistics, and white-collar professions have slowed down or quietly vanished. For workers in those sectors, the shift may be subtle, but it's significant. Hours become less predictable, raises are delayed, and job searches take longer than anticipated. Another key indicator of this shift is the rise of part-time work, not by choice, but because individuals can't find full-time positions. This type of underemployment doesn't always register as an immediate crisis, but it gradually undermines financial security. Income becomes more difficult to plan around, and even small expenses begin to feel more precarious. This is where emotional spending and debt intersect with the realities of employment. The strain from the changing job market feeds into the cycle of spending to cope. And without stable income, the foundation begins to crack under the pressure. When individuals feel uncertain about the future of their income, whether it will grow or even stay steady, long-term financial planning tends to take a backseat. Saving becomes less of a priority. Financial flexibility feels more fragile. And people's focus shifts toward securing stability in the present rather than preparing for future uncertainties. This shift doesn't require the labor market to collapse completely. It simply needs to stop showing positive growth. Once that forward momentum slows down, households begin to adapt. They don't necessarily panic, but instead, they make quiet adjustments, often relying more on credit, stretching their budgets further, and holding on to the aspects of their lives that offer a sense of normalcy while they still can. This is why signs of stress in the labor market often manifest in consumer spending habits before they show up in official job loss statistics. People tend to feel these changes ahead of time, even when the data hasn't fully caught up. When spending continues under pressure, the impact doesn't disappear, it simply shifts. The consequences often show up in places that don't immediately cause discomfort. Which is why they're so easily overlooked. Savings contributions slow down, emergency funds thin out, and long-term financial goals quietly recede into the background. For many households, the decision isn't about whether to spend or save. It's about balancing the need to preserve normalcy today with the sacrifice of optional financial security in the future. And since tomorrow often feels abstract and today feels urgent, the future tends to lose out. This dynamic is where the real risk builds up. As financial buffers shrink, households become more vulnerable to minor disruptions. A car repair, an unexpected medical expense, or even a few weeks of reduced income can suddenly feel much heavier than they would have in the past. The margin for error vanishes long before we see any visible collapse in spending. Homeownership serves as a prime example of this pattern. Higher costs and rising interest rates have already placed homeownership beyond reach for many. And continued reliance on debt alongside reduced savings only widens that gap. What starts as short-term coping can slowly evolve into long-term exclusion. Retirement savings follow a similar trend. Skipping contributions doesn't feel urgent when the benefits are decades away. But over time, those missed contributions build up into fewer retirement options and a greater dependence on savings in later years. None of this happens instantly. And that's what makes it so dangerous. Spending remains steady. Life appears to be functioning normally. And the system seems stable, until it's not. When financial conditions do tighten, households with less flexibility will feel the impact first and most severely. The real risk isn't that people are spending, it's that they're spending while slowly eroding their ability to withstand future financial shocks. This vulnerability, which no amount of short-term resilience can mask, will eventually surface. It's easy to see the current situation as a problem unique to the United States: rising costs, overextended households, and spending that feels detached from reality. However, when you look at the bigger picture, these same patterns are emerging across other developed nations. Countries like Australia and Canada are facing similar pressures. Where the cost of living has outpaced wage growth, housing affordability has significantly declined, and younger generations are reporting lower life satisfaction and more pessimistic outlooks. Despite stable economic indicators, in these countries, just like in the US, spending has not fallen off a cliff. People are still traveling, shopping, and engaging in the economy. However, the reasons behind this behavior are remarkably familiar. During the pandemic years, asset prices surged, access to credit became easier, and everyday expenses increased without any corresponding boost in financial stability. In response, households adapted by focusing on the present and pushing the uncertainty of the future further away. This is significant because it shifts the entire conversation. What we're witnessing isn't reckless spending driven by a single culture or policy. It's a global response to a profound shift in how people perceive economic stability. When systems feel less predictable, people tend to prioritize what feels tangible, immediate, and emotionally stabilizing. Spending moves from being a hopeful gesture to a means of preservation, preserving lifestyle, identity, and a sense of progress in a world that feels increasingly difficult to plan for. This is why the pattern persists and is unlikely to fade quickly. It's not driven by one policy decision. a single election, or even one economic cycle. It's rooted in a deeper loss of faith in the idea that waiting for the future to improve will yield rewards. Once that belief erodes, people's behavior shifts everywhere, all at once. So, when you see packed restaurants, crowded flights, and headlines reporting strong spending numbers, it's important to pause and reconsider before making assumptions. Spending doesn't always reflect confidence anymore. More often than not, it reflects adaptation. Emotional spending has become a coping mechanism for prolonged uncertainty. And the availability of easy credit has made this coping strategy sustainable, at least for now. At the same time, inflation has quietly raised the cost of everyday life in ways that haven't yet been fully absorbed by the public. These combined forces can keep the economy moving in the short term while households grow increasingly fragile underneath. This doesn't mean people are being irresponsible. It means the financial rules they're responding to have changed. The real risk ahead isn't that spending will suddenly collapse, it's that the flexibility to weather challenges will disappear. And when that flexibility is gone, even small shocks can cause disproportionate harm. The real question isn't whether people will continue spending, but what they're sacrificing in order to keep doing so. The longer this trend persists, the more costly that trade-off becomes, not only for individuals but for the broader economy as well.